What's going on, you guys? My name is Zach Hartley, and in this video I'm going to tell you everything I know about trading and investing taxes here in Canada. Let's dive right in. Okay, so just to get us started, you need to know that I am not a tax professional, and this video is going to be focused on Canada. Most of the rules apply to the US as well, but it's going to be focused on Canada. Now, in Canada, there's basically two different ways that you can classify your profits when it comes to taxes. Option number one is capital gains, and option number two is income, and I'm going to walk you through both of those options as well as the determining criteria right now. Okay, so let's just start with capital gains. So if you make a bunch of money in the stock market and you want to classify your profits as capital gains, here's what you need to know. Capital gains refers to making money by buying and selling assets. So if you buy and sell stocks, bonds, houses, cars, anything like that, you can probably classify it as a capital gain. An example of this is buying Apple stock at $100 and selling it at $200. This would give you $100 of capital gains. Now, the taxes on capital gains are fairly unique, and they're actually really nice because you only get taxed on 50% of your capital gain. So if you make $100, you only have to pay tax on 50% of that. And the percentage that you pay tax at, or your tax rate, for instance, is determined by your marginal tax rate. So meaning that whatever bracket that you're currently paying taxes at here in Canada right now, that is the bracket or the tax rate that is going to apply to your capital gains. So if you make $25,000 here in Canada, you're probably paying tax at like 15 or 20%. But if you make $200,000 here in Canada, you're probably in the bracket of 40 or 42%. And so whatever bracket you are in, that is the rate that will apply to the 50% of your capital gains. So really, really nice. Here's an example of it. You make $100 and you're in the 35% tax bracket. You get 35% tax on 50% of your capital gains, and that would leave you with a $17.50 tax bill. Now, this is just simplified math here, so you can kind of understand the concept here, but really not that complicated. You get taxed on 50% of your gains, and you get taxed at your marginal tax rate. Now, a couple things to know about this specific thing here with capital gains is that number one, you can write off your capital losses. So let's say you make $100 on Apple and you lose $20 on Microsoft. You can deduct that $20 from your $100 here at Apple, reduce your capital gains to $80, and then you'll only have to pay tax on that $80. With capital gains, you'd pay tax on $40 of that. So really nice here. You can write off your losses when you file your taxes or your profits as capital gains. Now, the downside here is that you cannot write off your expenses. So your commission, your internet, your cell phone, your office, all of those things are just expenses that you're gonna have to cover yourself out of your own pocket, and you cannot deduct them from your income on the tax side of things. So that's something you need to be well aware of, because there is a difference here, because on income tax, you can do that. So if you decide to not file your profits as capital gains, that means that you're gonna have to file your profits as income, and income is taxed a little bit differently. So all of your profits, when you file as income, are going to be considered taxable, meaning that you have to pay tax on 100% of your profits. Now, what determines if your gains are income or capital gains? That's a really good question, and I'm glad you asked it. And here are the 4 factors that determine whether you can classify your profits as capital gains or if you have to classify them as income. You do not have a choice here. It is determined by the CRA, and it's based on these factors. So the first factor here is how often you trade, and then how long you hold securities, how much time you spend trading and researching, and then how much money you make. And so if you do a lot of trading, or if you hold the securities for a short period of time, if you make a bunch of money trading, or if you spend a whole lot of your time trading, that is going to mean that you're probably doing this as a job, probably doing it as a business. And if you look like a business and smell like a business, you need to pay tax as a business, and that is why you need to pay income tax. And so you do not have a choice here. If you are day trading every single day, or if you are sitting at your computer and swing trading every single day, you probably need to classify that profit as income. If you're sitting at your computer once a week or once a month, reviewing your investments and making a couple trades here and there, you're probably totally fine filing your profits as capital gains. Now, there are some advantages of filing your profits as income, and the one advantage, like I mentioned earlier, is that you can issue your expenses as write-offs. Basically, what you're doing is you're reducing your profits that you're making with those expenses so that the amount of tax you pay is on that bottom number there, and it's after the expenses. So if you make $100,000 and then you spend $20,000 on commissions and internet and softwares, you're only gonna have to pay income tax on $80,000. And basically, all of these expenses here would be good verifiable expenses. Anything that will help you sell more or make more money is usually considered an expense. Definitely check with a professional though if you're starting to write off some sketchy stuff. But here's a quick example. So let's say you make $50,000 trading, you spend $10,000 on your commissions, your computer and your internet, you'll have to pay income tax on $40,000. And that is basically the same type of tax that you would pay if you earned a salary or if you earned an hourly rate. You're basically paying your normal salary tax. Now, just to give you guys a great example and show you kind of both of them side to side, we're gonna look at a tax calculator here. This one is hosted by Wealthsimple, and I have a link down below that will give you 2 free stocks when you open an account with Wealthsimple. So even if you don't wanna use the platform, I highly suggest you do it because you can get 2 free stocks, and I think they're valued up to like $3,500. It's really, really amazing, and I've got a couple of really nice like $200 and $300 stocks just from people signing up. So I promise you, it's well worth the time. I will put a link down below, but let's jump into the Wealthsimple tax calculator. I will also have that linked in the description down below. And here is what it looks like. Now, the first thing that you need to do here is choose a province or territory where you live. So I live in Alberta. We'll just use that for this example. So let's say that you work a normal job and you make $50,000 per year, and then you do some swing trading and you do some long-term investing on the side, and you're able to classify that as capital gains because you're not doing it every single day and you're not sitting at your computer every single day. So let's say it's capital gains and you make $10,000 here. Well, what's really nice about that is that if you look at this, here's your total tax number, and you're currently paying $12,363 because you were able to classify that $10,000 as capital gains. However, let's say that $10,000, you were sitting at your computer every single day, you were working really hard, you were making several trades per day on top of your regular job, and because of that, you have to classify it as business income or as personal income. Well, here's the difference. Our number is gonna go from 12,363, and I'm gonna reduce our capital gains, I'm gonna add it to our employment income, and as you can see, we are now at 14,368. And so just by changing from employment income to capital gains, that made a $2,000 difference in our tax bill on $10,000 worth of profit. And so it makes a massive, massive difference. So it really, really makes a big difference. And you need to be well aware of which category you fall into based on the 4 criteria that I outlined before. Now, if you do fall into the category of business income, there's a couple different ways you can structure this. Number one, you can just classify your profits as additional income. And what's nice about that is it's really easy to file your taxes. You don't really have to do anything else. If you don't want to do that, you can also file it as a sole proprietorship, which is actually a very similar process and also very easily. But if you have multiple businesses, multiple streams of revenue, and you're trading a lot, you might want to set up a corporation. Now that's going to take a whole lot more work. You're also going to have to file yearly and annual taxes. You're going to have to stay on top of your accounting. You're going to have to basically put that corporation together, but it does give you a couple of advantages, and you can hold some money and some investments in that corporation, which can be an advantage depending on what you want to do. Me personally, I have all of my income streams go into a corporation. I hold the money in that corporation. I pay myself a salary every single year, and I use that salary to invest in my own personal investments. I do have corporate investments though that are also very, very nice because I can use that money and invest that money before paying personal income tax on that. And so depending on your lifestyle, depending on your business and how complex it is, you probably want to just start off by filing personal income tax, then a sole proprietorship, then a corporation. It really depends on how often you're trading and what your life looks like, but that would be my best advice. Now, the last thing that I want to cover here is registered accounts, because in Canada, these can give you a huge advantage, a huge step up, and they can save you a ton of money. And there's 2 main registered accounts that I use in Canada. First one is a TFSA, that stands for tax-free savings account. And basically it allows you tax-free capital gains. So if you invest in Apple at $100 and you bring it up to $200 and you sell it, if you do it in a TFSA account, you do not have to pay any capital gains on it. It is completely tax-free, and it's really, really nice. However, there's a limit to how much you can contribute to that account each and every year. Usually it's around $6,000, so you cannot just load it up with 100 G's and never pay tax on your investments. I wish that was the scenario, but it really just depends on how old you are. Now, the second type of registered account here is called the RRSP, and this stands for Registered Retirement Savings Plan. And what's really nice about this is that it is tax deductible contributions, meaning that if you make $100,000 in this year and you put $20,000 of that towards your RRSP, you're only gonna have to pay tax on $80,000. And so it can reduce the overall tax that you pay, and it's a huge, huge advantage if you make a lot of money. So if, for instance, if you're in the 42% tax bracket right now and you make an additional $20,000, you would have to pay 42% tax on $20,000. But if you put that towards your RRSP, you can reduce your tax by $20,000, and it makes a massive, massive difference. You can also withdraw this for a first-time home purchase, but if you don't do it for a first-time home purchase, there are some withdrawal penalties and there's some rules around both of these accounts. So you definitely need to do some more research, but I personally max out both my TFSA and my RRSP each and every year because they give huge, huge tax advantages. And I think they're both absolutely phenomenal. Now, that's it for this video. I know I covered a ton of information here and I barely scraped the surface of taxes in Canada. So if you have any topics that I didn't cover here, you want me to dive in deeper into anything, please leave a comment down below. I'm gonna make a couple more videos about taxes here in Canada because it's the perfect time of the year. It's tax season right now and everybody needs to get well prepared, and hopefully you get some money back on your taxes so you can invest it back into the market. That is the goal here, and hopefully I can help you get more money back with these videos. So if you want to see anything, leave it down below. I sincerely appreciate you watching this video. Please remember to click that like and subscribe button, and we'll see you in the next one. Good luck trading, good luck investing, and we'll talk to you soon.